Shujin, of course, China's banks are very exposed to what's been going on in the property market as well, and we saw from the results yesterday profit slipping. How well equipped are China's banks to withstand this long winter in Chinese property?
So first is that regarding to the China bank's property decline, it was mainly due to the net interest margin contraction rather than the asset quality pressure. In the first quarter, the bank still reported NPL ratio quite stable. Some even see the improvement quarter on quarter in NPL ratios, especially those large SOE banks. So the net interest margin pressure is the key issue, is the key pressure for the reported profit. For banks, we still see the net interest margin contraction in the rest of the year until first quarter next year, mainly affected by the LPR cuts, especially in the first quarter this year. We will still see some loan pricing as well as new loan yield will continue to decline due to the very weak credit demand this year.
So when do you see the actual bottoming out for margin erosion? Because it's hard to see a situation right now that the government stops pressing on these banks, right?
Very good question. So yes, on one hand is that we still see banks' loan growth are much higher than the nominal GDP growth. Like especially for SOE banks, we see that you can see that the first quarter loan growth is still around 12% or at least more than 10% year on year, while the nominal GDP growth in the first quarter is actually lower than 5%. So this situation may continue in the rest of the year. Therefore, the overall net interest margin, as we just mentioned, will still decline. So the earliest time that we expect the net interest margin bottoming is first quarter next year, due to both the weak credit demand and as well as the LPR cuts.